We have C. Rudramurthy as well as Kunal Bothra joining us on the technicals. Kunal, I was reading this morning a note coming in from Lawrence Belanco of CLSA. He's talking about how the downside on Nifty has opened to the level of 22,000 now, and the bank Nifty can topple to the level of 45,000. Do you see any possibility of that?
So I think what happens, Anisha, is that when the market gets into such kind of a strong trend on the downside, it's bound to be that the indications or the legs for the index opens up on the downside, and we generally see further leg of correction. But then we have to understand the construct of the market, that after yesterday's price action, this bounce back, if it sustains for the index, we could be hitting a zone of a pause for the index over the near term. Now, pause necessarily doesn't mean that we are looking at a V-shaped recovery. It could also mean that we could just about stagnate at these levels for maybe few trading sessions or for the next couple of weeks. So I think what we could probably establish over here, because over the last 7-8 days, we've seen a very sharp correction, not just across the indices, but across so many large cap names. You've seen large cap stocks falling by a margin of 20%, mid cap, small caps, they've fallen by a margin of 25 to 30% plus, for themselves in just the last 6-7 days. So that there's bound to be a point where the indicators are oversold, and oversold doesn't necessarily mean that we are looking at a V-shaped recovery. It just indicates that the markets would get back into a phase of a pause. The correction could halt for some more time before we resume one more leg of downside for the indices. So my expectation is that over the next couple of days, you might see the index pausing a bit, the pace of correction halting and dropping down significantly. On the way up, there are a slew of resistances for the indices. So you have 23,500, which would now act as a major resistance for the index over the very near term. And I think more important than that, we have to break that pattern of lower highs and lower lows for the index to sustain any kind of a major uptrend.
But you won't go out and buy the Nifty just yet, would you?
No, not yet, because we require a lot of confirmations. Market breadth has to recover. You need to have large cap stocks which could lead the charge from the front, and that building block takes a lot of time for the indices, because we need to see which sectors, which stocks, large cap wise, which are the ones which go into a front runner uptrending mode. So I think that's a pattern which generally takes at least few weeks for the indices to shape up. So that's why I would not be in a hurry.
Rudra, hi, afternoon. Banks, real estate, energy, all sectors crumbling down. What's looking like the weakest link to you in the market sectorally?
See, definitely high beta is taking a turmoil, and you can see all these even specific counters which were all moving, like whether it is Adani group of stocks or even for that matter stocks like your Paytm, Zomato, all these new inclusions in F&O has got just bruised and beaten down. So for me, these things can still correct for some more time, and valuation comfort has to emerge in these areas. And we have also seen swift move in these stocks which are now seeing some amount of correction because of profit booking, and also valuation wise these stocks can still correct and give us mouth-watering levels to buy. So for me, overall market, yes, broader market pain can continue. On index, you only see a correction of about 12% from the top. But if you see the broader market, most of the stocks are down 30 to 50% on an average. So for me, yes, we have to wait out for some more time, look at for any new changes to come either through budget, or we want to see this FII selling to stop, dollar index to stop, or can any global magic can be done by Trump after he takes power. We have to see any of these things to change or provide us some amount of light at the end of the tunnel, and then see if market starts recovering from those zones. Yes, fresh money can be put in. So for me, both Nifty as well as Bank Nifty will see some amount of time-wise correction from here. Broader market can see some more correction to come back to the fair value or true value, and one has to be very stock specific at those levels to buy into.
Okay, one needs to be very stock specific. But Kunal, that's been a problem even at the stock level. I mean, if you look at the mid cap and the small cap indices, that is where the bulk of the pressure is. I mean, 4% kind of drop that we saw yesterday, and individual names, as Aisha was pointing out, are down anywhere between 30 to 50%. What's the take on the mid cap and the small cap indices now?
So, in a typical correction, Anisha, that first leg of the correction is generally led by large cap names, where you see large cap stocks go into a correction. Once and because the markets went into a frenzy in the mid part of 2024, the mid caps and small caps, they were the ones which reacted late. And then the last pain is generally felt into the mid caps and small caps, and the pain is felt very hard into these indices or individual stocks. as the case may be. For example, just over the last 3 days back or 4 days back, there was a point where the Nifty and the Bank Nifty had broken below their respective 200 moving averages, but the small cap indices and the mid cap indices, they were trading above their long term moving averages. And now with this increased pace of correction for the index, there was bound to be benchmark index, there's bound to be a point where the Nifty mid cap and the small cap had to come back and fall below their long term moving averages for this mean reversion or this divergence to correct by itself. So I think after the last 3 days or 4 days of very sharp correction, we are at a point where major of the indices, mid cap, small cap, the Nifty 50, Bank Nifty, etc., many of these indices are now trading sub their long term moving averages. That completes the odd divergence which was playing out for the index.
Okay, Rudra, what about the stocks that you've picked out today?
See, for me, two stocks look very strong in this market. One being Reliance. Reliance is definitely finding support at levels closer to 1200. No doubt from those top it has corrected enough. But then for me, there is some amount of relative strength shown in Reliance and expecting some positive numbers to also come in a 2-3 days time from now. Reliance looks strong to me. Even on chart, yes, levels closer to the 1220, 1230 has been a strong support zone. So risk reward is very, very favorable from current level. So look at buying Reliance with a target of 1280 and a stop loss of 1210. And for me, another stock which was relatively very strong even in yesterday's market, or even if you see for last 1 week, Bajaj Finance looks so strong to me. Risk reward at current level definitely gives a good buy call. So for me, Bajaj Finance is a buy for a target of 7,350. Positionally, one can definitely look at going long here. Keep a stop loss of 7,050 and go long on Bajaj Finance. So yes, a buy call on Reliance and on Bajaj Finance.
Okay, yes, interesting on Reliance because on 16th Jan it comes out with earnings. So just ahead of that, you're expecting the stock to stay strong. Hasn't done much, at least over the last couple of years. But let's see whether it manages to outperform this year or not. But Kunal, your stock specific recommendations?
Yeah, I'll bet on Reliance too, because my expectation is that if the markets require large cap names to participate, they would require large cap stocks which over the last 1 week or 2 weeks have been a lot more resilient and not participating in the correction. I think RIL stands to be one of the stocks in that case. So we'd look out for targets in the range of 1260, stop loss to be kept at 1215. And Biocon is the other stock which apparently has, in the thick of all the news flow surrounding the stock price, has looked fairly attractive. The stock has been holding up to a major support around the 350-55 mark. So keeping a stop loss of 357 would suggest a buy with a target of 388.
Okay, in fact, just talking about Biocon, HSBC upgraded the stock this morning to a buy. The target price has been raised quite substantially. Earlier, it was sub 300 bucks. Now on Biocon, they're expecting a target price of 430 rupees. Over the last couple of weeks, we have seen upgrades come by for Biocon. The news has become positive with the clearance of a couple of facilities as well. So definitely some momentum there as far as Biocon is concerned.
Yeah, other than yesterday, Biocon managed to withstand the market volatility too. But power financiers, they are the ones which are in focus. There's an initiation from the House of ICICI Securities on both PFC as well as REC. A target price of 550 on PFC, and on REC it's a buy with a target price of 600. They're saying that the transmission pipeline, and a strong one at that, is going to aid growth story for both these companies, and that they have a 20% market share each. The energy transition funding is going to be a key trigger going forward.
I look at the positioning of these stocks differently. I mean, they'd become the cult stocks about a year ago. Everybody wanted to buy PFC or RAC without realizing even what the businesses were. So this cult stock reputation what these stocks have, that has faded away. They've corrected substantially, both in terms of commitment, the weak hands are out, and also in terms of the open interest, the stocks have come to reasonable levels. But that's not the reason why you should have these stocks on your radar. If interest rates come down, NBFCs, they always benefit, and I expect the interest rate regime to be gliding down because growth has to make a comeback. B, the NBA concerns are not there. C, the dividend yields I think is at play, and typically when you are going through this kind of a market where you will see low PE and high dividend stocks, they tend to do well. So the big picture is strong, valuations are reasonable. You want to say in this market they are attractive, they are reasonable, the excesses are out, And if interest rates they come down, they tend to benefit. We all know that how government is looking at really shoring up the commitment in the power space. And to be fair to them, they've not done any kind of a reckless lending which in a sense could cause them to tumble in at least next 2 or 3 years. I mean, looking at what the loan book is. So if you put all those things together, I think there is merit in revisiting these stocks because the excesses are out, and now there could be a case of outperformance relative to the markets. If markets will fall, they'll also fall. But can they fall less given the construct of the business they have and the multiples they have to offer and the lever of interest rate? The answer to that is also yes.